Talent feels powerful. It feels rare. It feels superior. It feels like an advantage. And in many domains of life, talent does matter. In academics, intelligence often wins. In sports, natural ability gives an edge. In business, creativity and insight can create leverage. But markets are different. Markets do not reward potential. They reward behavior under pressure. And that is why discipline beats talent in investing. Not sometimes, consistently. Most investors believe success in markets comes from superior analysis. They believe the smartest person in the room has the highest probability of winning. They assume that deeper understanding automatically leads to better results. It doesn't. Markets are probabilistic systems. Even perfect analysis cannot eliminate uncertainty. Even strong theses experience drawdowns. Even correct ideas can take years to play out. Talent might help you design a strategy. Discipline determines whether you survive long enough for it to work. Here's the uncomfortable truth. The market does not test intelligence. It tests emotional stability. It tests patience. It tests restraint. It tests your ability to execute rules when your instincts demand you break them. And this is where talent often collapses, because talented people trust themselves. They trust their judgment. They trust their instincts. They believe they can adapt in real time. But real-time adaptation under emotional pressure often becomes rule-breaking. Imagine two investors. The first is highly intelligent. They understand macroeconomics, they understand valuation, they understand market structure, they can build complex models. The second investor is average in analytical ability, but they follow predefined rules. They limit position size, they respect diversification, they cut losses consistently, they avoid overexposure. Over a long enough time horizon, the disciplined investor often outperforms a talented one, not because they are smarter, but because they make fewer behavioral mistakes. Talent creates confidence. Confidence can turn into overconfidence. Overconfidence leads to concentration. Concentration increases emotional volatility. Emotional volatility leads to impulsive decisions. Impulsive decisions destroy consistency. And consistency is the real edge in markets. One of the most misunderstood dynamics in investing is this: markets do not reward brilliance. They reward repeatable execution. A brilliant investor can have one extraordinary year. A disciplined investor can have 10 consistent ones. And compounding favors consistency, not intensity. Discipline expresses itself in small, boring behaviors. It shows up in position sizing. It shows up in respecting maximum loss limits. It shows up in doing nothing when nothing needs to be done. It shows up in accepting that uncertainty is permanent. These behaviors do not feel impressive. They feel restrictive. They feel conservative. They feel limiting. But those limits create survival. And survival is what allows capital to compound. Many investors believe they fail because they lack knowledge. In reality, they fail because they lack constraint. They override their own systems. They increase risk after a winning streak. They hesitate after a losing streak. They abandon structure when emotions intensify. This is not an intelligence problem. It is a discipline problem. Let's go deeper. Discipline is not about willpower. Willpower collapses under stress. Discipline is about structure. Structure means predefined rules, predefined risk, predefined exposure, predefined exits. Structure removes negotiation during emotional spikes. Because the moment you start negotiating with yourself, talent becomes a liability. You will justify exceptions. You will rationalize deviations. You will explain why this time is different, and sometimes you will be right. But long-term performance is not built on sometimes. It is built on repetition. Consider professional trading firms. They do not hire people because they are the most creative. They build risk frameworks. They limit leverage. They enforce daily loss caps. They audit behavior. Why? Because they understand that uncontrolled talent is dangerous. Raw intelligence without structure is volatility. And volatility in behavior leads to volatility in results. Another reason discipline wins is that it reduces decision fatigue. Markets create constant opportunities to act. Every candle invites reaction. Every headline invites interpretation. Every fluctuation invites adjustment. Talented investors often feel compelled to respond. Disciplined investors filter. They ignore most signals, they execute only predefined setups, they reduce decision volume, and fewer decisions mean fewer emotional mistakes. There's a psychological comfort in believing talent is enough. It protects ego, it maintains identity, it allows you to think that if results are poor, you just need better analysis. But analysis rarely fixes behavioral inconsistency. Structure does. Discipline also protects against success. This is rarely discussed. After a streak of profitable trades or investments, talented investors often increase risk. They trust their momentum. They believe they are in sync with the market. They scale exposure. And that is often when variance strikes. Discipline prevents this escalation. It keeps position size stable. It maintains limits. It prevents confidence from expanding risk. And that single difference can determine long-term survival. Let's make this practical. Discipline means you define your maximum risk per trade before entering. You accept that some trades will fail. You never increase position size because you feel right. You never move stops to avoid emotional discomfort. You never add complexity to escape uncertainty. You accept drawdowns as statistical events, and you continue executing your process even when it feels uncomfortable, especially when it feels uncomfortable. Markets amplify emotion. Talent amplifies confidence. Confidence amplifies exposure. Exposure amplifies consequences. Discipline interrupts that chain. It inserts boundaries. It inserts limits. It inserts friction between impulse and action. And that friction protects capital. If you want to win in markets, stop trying to be impressive. Start trying to be stable. Stop optimizing for brilliance. Start optimizing for repeatability. Stop asking, how can I be right? Start asking, how can I survive being wrong? Because survival compounds. Talent without discipline eventually self-destructs. Discipline without talent can still win. If you remember only 3 things from this video, first, talent creates opportunity, but discipline protects capital. Second, consistency beats intensity in probabilistic systems. Third, structure beats intelligence when emotions rise. The market does not reward how gifted you are. It rewards how stable you are under pressure. And stability is built, not assumed.